Hit it.
It's Friday, July 26, 2024, episode 244. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, Ryan Metcalf, the author of Street Smarts, joins us to tell us how he makes such a good-looking free daily letter, how he never takes a break, and why it's the perfect way to start your day. Then it's time for Patrick's Talking Charts, where he tries to explain what the heck is going on out there.
And then, folks, we'll drink some beers along the way. Danny, what beer are me and you drinking this week?
Today, we're drinking Castel Extra, and the description is a blonde fermented beer with a low alcohol content, and it says underneath surprisingly pleasant. So is it surprisingly pleasant?
Oh, it's very pleasant.
All right. Sounds like it's a mopey lightweight beer, even that I would like.
Yeah, there you go. Kev, give us a disclaimer.
Pleasant. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include margin call meltdown, tech stock tension, and the emerging market exhaustion.
All right, let's get the guest on.
It's our great pleasure to welcome to the show Ryan Metcalf. Ryan is actually the author of the Street Smarts letter by Market Lab, and it is just a fantastic letter that I just love getting in my inbox every single day. And so Ryan was kind enough to come in and tell us about his letter, what he's trying to accomplish and stuff. So thanks for coming on, Ryan.
Thank you so much, Kevin. It's great to be here.
Yeah. So why don't you tell people a little bit about the letter, what you're trying to accomplish, what you sort of stuff you get. And, before we start and, start talking about the letter, let's just remind everyone it's completely free. It's a Substack that, has all sorts of wealth of information, and everyone should go and sign up right away, because I think it's something that helps me in my trading every single day. So what are you trying to accomplish with it?
Oh, well, thank you so much. So I started it, and kind of the idea there was there are a bunch of other morning notes out there, but they tend to just kind of follow this style of here's a paragraph, here's another paragraph, and then maybe a meme at the end. And there's no real data. And I don't really think anyone really likes just trawling through stuff. It's, 7 a.m. So the idea is I try to integrate a lot of data, a lot of information. It's mostly chart driven. You don't even have to read it if you don't want to. You can just kind of skim. And right. I guess the overall punchline is that I want it to be something that if you read it every day, then, whether you're a beginner or whether you're a pro like you, Kev, you get something out of it. And if you are just starting out, if you follow it long enough, then you at least kind of feel like I know what's going on. I have an understanding of what's taking place to market, what the big themes are, how everything's taken out.
One of the things that I'm always jealous of when I look at your charts is that you're making all these charts from hand, like you're creating them all, and they're just beautiful. Like, is that Excel?
It's Excel, and I kind of do sometimes a little bit of stuff in PowerPoint, but I think I got too much brain damage from my days in investment banking, and I'm just like very anal about my charts. So they take most of the time as opposed to the writing.
All right. So let's talk a little bit about that, because one of the things that I'm excited to have you on for is that you're a younger fellow that's been in the hedge fund and on the sell side recently. And me as an older guy, when I start giving, young people advice about getting into this industry, I realize my advice is getting kind of old. Like I've been around for a long time. Like, geez, when I started my career was like we hadn't even changed into the 2000s. So I'm giving advice based upon old stuff. And one of the things that I think is great about you is that you actually have been out there and getting jobs on the hedge fund or the sell side. So I'd love to kind of talk to you about that. But before we do, let's just kind of review your career trajectory. Like, first of all, like, did you always know you wanted to be in finance?
I think so, at least as far back as I can remember. I think when I was a kid, I wanted to be a pilot, but then I realized that airline pilots just kind of take off and then do nothing for 6 hours. And I got into the stock market in my kind of early teenage years. I think I opened up my first brokerage account at 14. And I had a very kind of sporty background, played competitive hockey, competitive golf. And it's just the idea of like having a scoreboard every day out there trying to compete, being challenged. It's different every day. My job all the way through high school was, working at Loblaws. And I was like, same thing every day. I can't do a job like that. So just kind of developed the passion in the stock market. I remember Howard Marks reading his newsletter when I was like 16, maybe probably over my head there. But the overall job was I always wanted to be a stock picker, nothing else. So I started off in investment banking. But kind of basically just fully accepting like it's going to suck for a couple of years, but it's, the pathway, it's one of the best ways to get a job, asset manager or a hedge fund. So
right. Okay. So you went to school at Western, which is a very famous business school in Canada. And did you go out from there and get your investment banking job?
Kind of. I mean, I had the misfortune of graduating right at the end of the financial crisis. So I was doing full-time recruitment in fall 2008, if you can imagine how great that was.
Oh, God.
So then I thought I was like, okay, get a job shoveling snow or maybe do a little bit more schooling. So then I went to U of T and I did a master's in financial economics. So like half MBA, half econ.
Right. So I was wondering if
the internship in Toronto.
Right.
I thought I was all set. I had $130,000 in debt. I had a job. I was like, okay, this is great. And then my wife was a trader at TD and moved out to London office. So then I ended up going out to London, no campus recruitment, no friends, never been to the country before, but somehow I ended up with a job offer and ended up spending a couple of years at Credit Suisse.
All right. So you were on the sell side there in investment banking in Credit Suisse in London. So what was that like? A good Canadian boy, not a lot of snow to shovel there. Do you enjoy your time there?
Different because I don't want to say like it's a class-based system, but like in high finance, you can tell like everyone had a signet ring. Everyone went to like not just Oxford or Cambridge. It was like one of 3 or 4 colleges at Oxford. The other ones were looked down on. So it's a bit different. But
I think you can say it's a class. I think you can say it's a class-based system. I think that they're fine with that. I think they've accepted that.
How many listeners that are from the UK? I don't want to say, but
no, there's going to be lots, but I think that they'll accept that.
Okay. But no, it was a great experience. But I do have the unfortunate distinction of leaving Credit Suisse in an ambulance one day. So yeah, it was kind of a hard
what happened?
Basically, I was a little sick, and then I pulled like 4 all-nighters to get something over the line. And then by the end, I was very, very sick. Came in the next day and was like kind of about to fall off my chair, basically.
And so they called the ambulance.
I went home and taken a taxi, but I think they didn't want to get sued. So they made me leave in an ambulance. Got to the top. They looked me over and were like, go to bed.
They worked you to the point where you're sick. Okay, so now you're there, you're working on the sell side. That's where you're honing your great skills in terms of PowerPoint and Excel. But you've always wanted to be a stock picker. So what happens from there?
So I always wanted to be a stock picker, but also kind of always wanted to come back to Canada. My wife was pretty open to that, just getting the experience. So basically tried to recruit back at funds in Canada, which, with the 6-hour time difference meant like, midnight interviews, which was a bit weird. But I ended up getting in touch with a hedge fund that was being started off the side of DRI Capital, one of the big healthcare private equity firms here. So I ended up joining them. They brought in a bunch of, PhD kind of science nerds, and they needed like a finance guy to put all the pieces together. So I spent some time there and then ended up leaving to go to Scotia, which had just bought Dynamic Funds. So then I was investing in healthcare and tech stocks there.
Okay. And then from there, you've decided now it's like time to take these skills and make this letter. What are you trying to do? You mentioned that you wanted to make it so that it was accessible for people who are just starting out, but also people that are looking for some more information. Why don't you tell people the sort of things that you put in that letter on a daily basis?
Yeah, so I think it kind of follows a kind of a definite structure. So like I have, kind of cheesy stuff. I do trivia every day, joke of the day, slap in some memes there. But the general structure is, I kind of walk through some of the big headlines. I usually have like 6 or 7 of them, and I kind of do a little bit more than an explainer. You see, so there's some other morning notes where they're just like, GE did this. And it's like, that's not really helpful. Right. So I kind of have that. But then the bulk of the newsletter is I usually pick 1 to 3 topics and I kind of dive in hard. So like I just did one the other day talking about the rotation. My note this morning was on tech valuations, basically just looking at, how lofty they are relative to history. So how much air is underneath them, just kind of basically trying to suss out and give people some flavor for, what kind of shape things could take if it kind of turns sour. And then I also do some deep dive stuff, like I did a Microsoft versus NVIDIA one the other day, just comparing growth, strategy, valuation, all the different industry metrics. I'm working on a Netflix versus Disney one right now. I do some like deep dives on like Tesla. So not enough to maybe you form an investment thesis on it, but, just if you're someone that loves markets, loves following this kind of stuff, then, you might not be interested in investing in Nike, but like, it was a big story how they're crumbling lately. I did a semi deep dive on that, walking through exactly why they're collapsing right now. So just kind of stuff that, might be helpful as an investor in the future, but just good to kind of understand some of the big themes and kind of the big issues going on in the market.
And then I think that one of the things you do is you create a visual from like those graphs, and you're putting together, showing what you're talking about. You're not just saying this is what's happening. You're then going and producing the actual numbers to show that.
I think that's a really important part of doing this job effectively. And just, from your other work too, like you can use a whole bunch of words, but at the end of the day, a lot of that could be BS, right? So you need the data behind it to support it. So, and a picture also says 1,000 words. So if you actually show someone something, I think they're more inclined to take what you're saying seriously. If it's actually, here's the numbers, it's verifiable, take it as you will kind of thing.
All right. So let's talk a little bit about some of the things that you see people doing incorrectly when it comes to their investments. And you've been around on the sell side in terms of seeing corporate finance, but then also on the buy side in terms of the hedge fund. So although you don't have decades of experience, you've seen some markets. What are kind of the things that you notice is the mistakes most people are making?
Yeah, I guess part of it too, like, because I was never, super senior PM. I was always the guy managing the juniors and the interns and things like that. So you got to see how people started off and how their psychology was at the beginning, and then how it eventually kind of, morphs as they kind of get a better feel for the market. And I think getting a feel for how markets work and how prices work is a big thing. And it does take a little bit of time and experience. A lot of people come into this job and they want to be the next Warren Buffett. They want to find the 50Xer right off the bat, and they want to build a portfolio of 50Xers. And all of a sudden it's just, value trap, bankruptcy risk, value trap. And you just see stuff like that where they're trying to beat the market by just expecting that everyone else in the street's dumb and it's trading there completely wrong, and there's a double out of it. And I think that's just, really common pitfall. Maybe if you've been doing it a very long time and you can really, really dig in there and have an edge. But if you're starting off, you have to accept that you don't really have an edge.
Right.
You're out there just trying to, find the good investments. And for me, that involves investing in stories that are growing. I'm a big growth stock guy. You bought Tesla at 60 times earnings, and oops, it went to 40 times earnings. But over those 3 years there, it, earnings went up by 400%. So you didn't get hurt on that. But it's when you got a company that's earnings are declining 3% a year and it's trading at 6 times, and you think it's going to go trade at 12 times. Well, you're probably going to lose your shirt. If you're wrong on the Tesla, then you at least end up with something that's worked out a little bit better long term. And then another thing I think that is probably the most common is, a lot of the kids that do this are very hungry. And I was just like this. Like, I wanted to learn every single thing about these companies. And I'd build these stupid models like, depreciation triangles, like trying to make sure that like all the non-cashes were right to the dollar. And it's kind of missing the forest for the trees there. So I have my own kind of spin on the 80-20 rule. It's the 93 rule. So if you're investing in a stock, figure out what the 3 big things are that are impacting it. Maybe it's 2, maybe it's 4, but that's going to result in 90% of what happens to that stock. So if you're thinking like, I don't know, Pfizer, you have to understand the vax business. You have to understand the oncology platform. You have to understand their acquisition strategy or whatever those kind of things are. And you have to know those things inside and out. The worst thing you do as an investment banker, if I want to take it back to that, is you get hired on a deal and you build these 6,000 line models, and they're massive, but you're running the whole thing off a revenue line. And it's like, what's it growing by? 4%, 5%, 6%. And it's like, it's better off to just have a 400 line revenue model and just 25% EBITDA margin, 7% net income margin, and build the thing out that way. Then you at least get the direction, If your revenue's off by a massive amount, it doesn't matter if your CapEx ratio was perfect.
All right. So you see people doing too many mistakes that way. One of the things that you have also experienced is you've worked at different types of hedge funds, and the industry's changing a lot. Like, what advice would you give to a young person today that's interested in this, getting onto the hedge fund? What would what would be the best path to getting in? And then what would their day look like? Like, what would their first few years look like? Kind of, what advice would you give yourself kind of 15 years ago.
Yeah, I guess I just say I can kind of speak on the fundamental equity side.
Right.
Quant investing is getting a little more popular. That's a whole different beast, and that's kind of that's almost not even investing in a lot of ways. That's math stuff. But if you want to actually pick stocks for a living, it's the career path is similar to what it has been in the past. It's just probably getting a little bit more competitive, and that's you got to come through equity research or investment banking. Investment banking used to be kind of the main way, but especially in North America, it's more pivoting towards equity research. So you got to, hopefully recruit well out of undergrad and get a job doing research. It's not the most, work-life balance kind of job. It's not as bad as investment banking, but, covering stocks that way is probably the best way to start. And then you kind of have to figure out what kind of investing you like. Like eventually I wanted to be, a long-term kind of fundamental investor. So that works out well for most asset managers. A lot of hedge funds are run like that, like your Oak Trees of the world. But then you have like your Millenniums, your Citadels, kind of pod funds. And it's just a totally different beast entirely. So a couple of my friends that worked at Citadel, like they're telling me like 90% of their alpha is, within the week before, the week after earnings. They don't really care about the business per se. They're not making a long-term call on something. It's just kind of quarterlies, buying credit card information, getting satellite pictures of parking lots so they can count cars to see how that's kind of going. The best way I heard it described to me is it's like playing a video game. It's kind of detached from the market in that way. So if you like that kind of challenge, that can be that side of the business. But if you're like me and, you actually like, having deep views on companies and digging in, forming like a long-term opinion and trying to find the winners that way, that's a whole different beast. As far as day in the life, I guess you kind of come in, depending on the shop, like 7, maybe 8, if it's a bit later. And I'd say a normal day, I'd probably have, maybe 1 or 2 meetings with some equity research analysts. Usually they kind of tour around town.
Right. Okay.
I'll be like, JP Morgan MedTech analyst is in town. Credit Suisse, or I guess not Credit Suisse anymore. UBS's pharma analysts in, or Citibank's brought their macro strategist in. So you kind of have a couple things like that.
Right. And when you meet with them, are you looking for ideas? Or are you just trying to figure out what they're thinking about? Like, what is the point of that? Given that that's kind of widely dispersed, right? Like everyone kind of knows what they're saying. So why bother?
Yeah. And it does give you a bit more of a chance to ask the particular question you have. And there is some idea generation in there, especially if you're talking about like kind of mid cap names that maybe don't get as much attention or that you haven't really had the time to look at. So if you got like a coverage universe, like say when I was covering healthcare, I had maybe like a 75 stock investable universe. The smaller ones, you don't get that much attention as you'd say like your Mercks or like your Pfizers or something like that. So it's good to just kind of be like, well, why do you like that? What's the business? And then they have a really nice feel as far as like a lot of the industry specific stuff. So even within, healthcare, I'm covering med tech, I'm covering the insurers, I'm covering the distributors, I'm covering biotech, I'm covering large pharma, I'm covering devices. There's a whole kind of there's a lot of different nuances to that. So getting to actually be in there and be like, hey, I actually don't understand the way that Medicare is doing, price increases this year. Can you give me some color on that?
Okay.
So it did help to kind of ask those kind of market specific questions too.
All right. So you meet with them, and then what does the rest of the day look like? And then ultimately, what are you making a report to present to the portfolio managers? Are you making recommendations? Like, how does that work?
Yeah. So again, you kind of cover the news, and once that kind of just knowing what the hell is going on in the world, hopefully, I've had this a bunch of times where you show up in the morning and you're like, one of my stocks blew up. Happens all the time in biotech. Like, they announced that they canceled their phase 2 trial early because of poor data and your stock's down 40%. So sometimes you wake up and you're dealing with a couple fires, but just general kind of day, you're usually trying to ramp up on some new companies or companies you haven't looked at in a while. So, trying to have a model going for every single one of them. Maybe not the most advanced things. Start off with something that may be small. And then once you kind of have some ideas, you put in a little bit more work. trying to understand a lot of the more qualitative nuances. So it can be different by firm. Some shops, they just like having an investment memo and you send out something brief and you guys meet and talk about it. I like to kind of, in a similar way to my note, put a lot of charts and graphs and some of my model outputs in there, kind of suss out the investment thesis. But,
right.
It all kinds of ends in some kind of one way or another, depending on how the firm does it. But the whole idea is basically saying like the stock's here. I think it should be here.
Right. And so you present it to the portfolio manager. Portfolio manager sitting there listening to all these different ideas, and then he or she is picking the ideas that they like best.
Yeah, and you get a bit more senior. You have pretty much autonomy over that. And again, it varies by shop. If you're at one of the smaller places, you could be 26-year-old and you're the one making all the calls. Right. If you're at like Scotia, like I was, and your team is managing $45 billion, and you're managing $5 billion in healthcare assets, well, you usually need someone to kind of sign off on that, even if we've been there a while.
Fair enough. The old CYA. All right. In terms of when you're talking about what you might give advice to young people that are like, obviously they got to do well in school, but what else would you tell them to do in terms of like to get this job? Like what should they be reading? What should they be interested in? Obviously Market Lab, like the Street Smarts is one of them, but what else can they be doing if they were interested in getting into this industry and working for a hedge fund?
Yeah, so I think you got to be a little bit keen with campus recruitment and try to get maybe some kind of financial internships a bit early. Most places you don't really get your big internship until the summer between third and fourth year. So if you can get a little bit of financial experience in there, it just makes it more likely to get that better internship. Right. It was the best I could do was that I got a job as a bank teller. Yeah. But, as far as like actually getting the job, making that step, you'd be surprised. Like you have these kids come out of business schools and they just really, have you ever built a financial model? No. Have you ever actually like dug into a company and looked at the 10K? Once, get a little bit of familiarity with that. You don't have to do anything elaborate, but just, a little bit of practice in Excel. Like you can find some basic models on the internet and just kind of fill them in. And just then you get used to seeing how the growth works. Track a couple of companies. The biggest advice I give to kids I've kind of mentored over the years that want to like leave the sell side and get into the buy side is to actually like go out there and publish some stuff.
Okay.
So put together a couple stock pitches. That's how I was able to make the transition. I would put together these pitch decks, PDF them, and it would be like, here's the company, here's the operations, here's the divisions, here's the competitors, here's the valuations, here's my model outputs. And I just send this around to a whole bunch of people and be like, here's 3 stocks I looked at. And then they at least get a feel for you. And it's a differentiator, because I've done some hiring on the buy side and, you just get resume. You post for a position now and you get 2,500 resumes. It's insane. So you really have to find a way to stand out. And that's, you got to put that extra little bit of work in there. You can be the greatest investment banker in the world. You can be the greatest, sell side research analyst. But, to stand out above everybody else, it requires a little bit of showing that acumen, showing that hunger, showing that little bit of extra effort.
I like it. Okay. So I'm going to try you on, you're going to be the first of my new final question. And my new final question is, before you leave, you can share either a new book, band, or broadcast, meaning a TV, movie, or podcast that you recently discovered. Something you want to share with us.
Can I pick an old one that I just did redid? And I think it is
sure. Sure.
I just reread Michael Lewis's Liar's Poker, and it's it's even more powerful now, I think, just because you kind of see the crazy world that it was, and the shifting sands. And even when I first read it, the investment industry looked like this, and now it's a total different beast. But it's just a great kind of time capsule of what probably the most interesting time in finance was. And it's just, Michael Lewis's first book. Other than that, I did Material World recently by Conway, just kind of like a summary of a whole bunch of like, I think it's like the 6 most important kind of minerals out there. They have oil, sand for silica, and it's gold. And it's just like an interesting kind of like primer on basically like what the commodity side that keeps the world going.
Okay. In terms of Michael Lewis's Liar's Poker, I completely agree. And, Spotify recently kind of teased and they said you could use their audiobook function. And I'm sitting there like, I got some free time on the audiobook. So I chose that as well. And I was shocked at the things that I had forgotten in terms of specifics and nuances. And it's just one of those things. It's the same like with Market Wizards. I go back and I read it every 5 years, and I think I know everything. I think that there's going to be nothing new to learn from it. And in that 5 years, I've matured a little and found some different elements. And I go, oh, you know what? I never realized this nuance. So completely agree with you.
Yeah, you got to renew the favorites. You can't just, it's better to read one of the classics over than just, find another regular book to read.
That's right. All right. So before we let you go, why don't you tell people a little bit more where they can find your letter, how it works? Just kind of give them the whole spiel.
So it's sorry, it's called Street Smarts.
Okay.
Our company's called Market Lab. So if you go to marketlabnewsletter.com, that's how you can find it. And then you can browse some of the older ones there and get a feel for what we offer. You can check everything out. And then if you like it, hope you sign up.
Yeah. And it's completely free.
It's free.
Yeah, that's the thing about it. And it's in you're very diligent. Like, do you miss a day ever?
I think I had one sick day, and then there was one time where I was like really under the weather, so I put together like a 1-pager kind of deep dive on a company and was just like,
yeah, you are the most diligent worker I've ever seen, and your charts are out of this world. It's terrific, and I highly recommend everyone to do it. And especially those, that have someone young in their life that's interested in the market, make sure that they sign it up, because I completely agree. It's not just something that's good for the professionals. It's also something that helps kind of people that are just new to the industry learn as well. So it kind of gives a little bit of an inside baseball view about how hedge funds and think about the world, or how buy side thinks about the world. And I think it's terrific. Ryan, thank you very much for being on. I really appreciate it.
Thank you so much, Kevin. It was amazing being here.
Take care. All right, Patrick, it's time for Talking Charts. What do you got?
Well, Kev, you weren't here 2 weeks ago when we were doing the last episode, so I had obviously Chase step in for you, but we're not going to review what we were talking about in terms of the top things to watch. But let's just start off with talking about the top 3 things to watch here in the coming 2 weeks. And we have the jobs numbers coming up this week, and I think this has been what everyone keeps watching is when will the things start to deteriorate in the jobs numbers? What are you watching there? Do you think this is the month that things kind of soften?
Well, I think a lot of people are expecting it, and it would be a big surprise if we didn't get that deterioration and we actually got a strong jobs number, because a lot of people are already anticipating it. It looks like the Fed is going to cut in September. This upcoming meeting, they're going to set it up for September. And it would be just like the market gods to give us a strong unemployment number that actually throws that in, that wrenches that up. But I think that if we do get the weak number that everyone's expected, there'll be no surprise.
No, for sure. All right. So number 2 is the Mag 7 earnings. And the AI earnings are, in my opinion, critical here, because I don't think just good earning results are going to be enough. It's really about guidance as to whether or not this is the end of that CapEx cycle. And clearly we saw with Google and Tesla, the earnings impact on the market instantly. And we obviously have Tuesday, Wednesday, Thursday, where almost all of them other than NVIDIA are reporting. What's on your mind here?
Well, I think you nailed it when you talked about the fact that the guidance is going to matter more than the numbers. And for the first time, we're getting some people that are actually looking around and saying, hey, wait, maybe this AI hype is a little extended. Maybe we've been a little too optimistic. And if we don't get that sort of continuation of growth, like, it doesn't even have to stop growing. It just has to grow not as fast. And we're going to have some real problems in the market. I think it's already here. I think, as you highlighted, it's going to be a difficult bar for them to step up over, and that it could potentially make a lot of fireworks in the market.
Yeah, I was just looking here. There was a great report written by Goldman trader Matthew Martell, and he was saying that past CapEx cycles in this space lasted 4 to 6 quarters, and we're in the 5th quarter of an expansion cycle, and he thinks that this is becoming an incredibly challenging period. And this is why I think it's so important to watch, because, maybe it is going to be pushed out one more quarter. Maybe this isn't the turn point. Maybe the market rallies on the earnings, but this is what it's going to be critical. We're going to watch and see whether or not the participants get a pulse on that. We'll take a look at some of those individual charts.
And before we go to the next topic, I just wanted to highlight the fact that Zuckerberg actually kind of threw some cold water on the whole AI story this week in terms of talking about the expectations have gotten a little ahead of itself, and that he could see a situation where this doesn't live up to the hype that everyone's expecting.
Absolutely. Another comment in that Goldman piece was that the signal that the tech bubble burst will happen is when the tech sales revisions start turning negative. And do you think that it's going to come this cycle here?
I think, this quarter, I think we are here. Like, I think this is the quarter where everyone wakes up and goes, holy smokes, we've priced these things for perfection. They're good stocks, but they're not that good stocks, and we have to reprice them. I think what's already started.
We'll get to that chart, because I want to talk about, let's say, that rotation into the Russell and other things like that. But we'll wait till we get some charts up here. But the number one thing to watch is we have the FOMC as well, with the Bank of Japan and Bank of England. So a big wave of central bank statements coming in there. Clearly, the market is priced in that they're going to be looking to see whether or not they're going to confirm the September cut, which is like 95% priced in. That's a given now in your mind?
I think so. I suspect there's even some talk. Dudley was, former New York Fed President William Dudley wrote an op-ed in Bloomberg and highlighted that he thinks that they should go for July. And there's some people trying to put on trades for that potential. And although I don't think that's going to happen, it's not out of the realm of possibility that they sneak one in. And if they were to do that, this is how it would go. It wouldn't be a situation where we go into the meeting, the market's priced for a 96% chance that they don't do anything this month, and that it happens in September. What would happen is over the weekend, you'd get a leak from Powell or somebody like that, and it would probably go to the Wall Street Journal, and it would be like, we're putting on the table the potential for a July, cut. And if that was the case, the market would instantly price, but it would be done before the meeting. The Fed doesn't like surprising people on the actual meeting. And given that we're just a few days away from the FOMC meeting, I think it's getting really tight. So the easiest, most probable bet is that they don't do anything this meeting, and that they actually do it the following meeting in September. But if you were to see that, surprise hike, it'll come in the form of a whisper, a leak to the Wall Street Journal or some news organization like that. So it'll instantly get repriced on a Monday or something.
All right, let's start off with the S&P 500, up 74 points here, Kev. A big rebound. Now, it looks like a lot of points, but we have to put it in context of the magnitude of the drop that we just seen in the last 5-6 days. This was like a solid 300-point drop, and the market was going to bounce. And in my mind, when we got down to this lower level around this just under 5,500, I was telling my members that this is a place where we were expecting the market to bounce, largely because I didn't think that the market was ready to make its really big move until after Wednesday, right? Like with the FOMC and all of those major earnings, odds were that we were going to have some sort of sideways consolidation come in here, and then on Wednesday, what results we have is going to be the determinant of whether or not there's another major leg down. Obviously, there's factors that could drive short-term selling. Obviously, systematic traders are starting to get hit here, right? Like we were testing that 50-day moving average. We were basically selling enough that a lot of whether vol targeting funds, whether CTAs, there are some systematic traders or even some dealers that have that short gamma that could have created a much more downside volatility. But on balance, I think here that the market settles in, and Wednesday is going to determine whether or not there's another key leg down. What I think that if there was another leg down, we could easily see 5,300 on the downside as a quick rapid drop, as in like over a couple trading sessions next week. But if this really stays anywhere below its 50-day moving average, we could completely approach those April lows near 5,000. And I think that's where we could put some short-term swing lows if it accelerated. That's all a lot of ifs, isn't it? But like obviously,
you are a technician, buddy. It's
yeah,
expected.
no, but listen. No, but listen. Technical analysis isn't going to predict how the earnings come in, right? Like there is a variable that is bigger than a chart pattern, and I think that what happens on Tuesday, Wednesday, and Thursday is going to really decide it, irrespective of any chart pattern. What are you going to say? Something?
I'm not disagreeing at all. Actually, I'm waiting to see where you go with this, because I do think that one of the hallmarks of the last few days that's been interesting is the fact that we get week closes, which is something we haven't seen in a long time. And we're taping this Friday at lunch, and I just think about yesterday, Thursday, we pulled up like the Nasdaq, and you look at the daily kind of intraday chart of that. It looked like we were headed higher. And
then it reversed right in the middle of the day. It's the hourly chart.
Yeah, and it closed terribly. And I think that is kind of, it'll be interesting to see where we close today on Friday. It is OPEX, so who knows? Like, there could be some action. But one of the things about this last week, and especially, or 2 weeks, is the fact that the closes have been very weak. There's been some real selling out there in the market.
I see that pattern. I still think that we could, for instance, we could easily see 19,500 on the Nasdaq by Tuesday. We could easily see the S&P 500 bounce back toward 55, 50, or even under the right circumstances, 5,600 right before the FOMC. I think the market taking a breather from the sell-off is a typical kind of reaction. And then we're going to determine whether or not from there this market rolls over or not. But what I want to, though, talk about is this really huge sector rotation that came in as all these money managers were loaded up on so much of these Mag 7s. They had to degross. And they sprinkled it in almost every other asset class. But particularly the Russell got one of the most love. Like, there was a point where last week the Nasdaq was down 5% and the Russell was up 10% on that news.
Yeah.
And
but just for, I don't mean to interrupt, but I do want to interrupt there. That was the largest outperformance of Russell versus the Nasdaq over that period ever, I believe. Like, it's
this is the Russell over Nasdaq chart itself. Like, it was a squeeze, because I think you had basically everybody playing the short Russell, long Nasdaq pairing. I think it was an unwind.
And I just want to remind everyone, like a month ago, what was everyone sure of? That small caps never go up and Mag 7 never goes down. And it was just like relentless. And it was just like, it was annoying to hear. And I just wanted to kind of remember, and whenever you hear that sort of lopsided kind of certainty out of the market, you know that the potential for a problem exists. And I think that people probably don't appreciate how much pain there is out there with this rotation
pairing.
Yeah.
But this is this is a flows issue where basically this is dealers having to tweak and rebalance.
It's not dealers. It's actually it's
not
clients.
dealers. No, clients. But I meant clients, like as in people having to reposition their trades. But in my mind, there's no good case to be long the Russell. This is an inflection point of the Fed cycle. It is common to have, during a cyclical downturn, margin compressions. This is a period where small caps typically do poorly, but yet technically it breaks to a higher high, and everyone's like, oh, these small caps are going to be in a bull market. Now, what I do believe is that small caps on a relative basis will outperform the Nasdaq moving forward. I think that is like where, I think that will play out, but I don't think they're going to have a negative correlation for much longer, where basically one will be up and the other will be down. I think it'll be a relative where Russell will be down less or will be up more on a period, but I don't think that they're going to move opposite for much longer. Maybe there'll be another week of some sort of squeezing, and then I think it's just going to be they'll be correlated, but the outperformance it'll just be a massive underperformance of the Nasdaq, because the Nasdaq is going through a huge Mag 7 mean reversion, and you're going to just simply have more safe haven in things that don't have the Mag 7 in it.
Yeah, I think that Patrick, you're pointing out the fact that usually small caps underperform in the final stages of a kind of a cycle is very interesting, because here we are and we're supposedly going into the final innings of this cycle, and yet all of a sudden small caps are just ripping. And I would just be careful, because I go back to Dario Perkins from TS Lombard. He always said this cycle isn't the same. Like we went and shut down the entire economy. We reopened part of it. We then threw all this money at it. We did all this fiscal. He says this has been anything but a typical cycle. And I think the fact that, we just had the largest outperformance of the small caps versus, the large caps, ever, shows you how much danger there is in this market and how much strange things can happen. And I think that one of the things, and you're saying you think that this is almost over, and listen, you very well could be right, but I just want to remind everyone the amount of selling of Russell and buying of Nasdaq was just relentless. Like, take that chart that you showed me and make it bigger.
Oh yeah, take this on a weekly chart, like it's insane. Hold on,
right? Like it's
been persistent, right? Like it's you can go back like 7 years.
Small caps are cheap compared to these stupid, for example, the Mag 7.
I think that's a trap when you say cheap. They are cheap, but the thing is that flows matter. And when fear
flows,
and
I
sentiment,
agree with you though, Patrick. Flows do matter, but everyone's underweight these things.
But okay, I
hear what you're saying. They might both go down. Completely get that.
Right now, if the Nasdaq heads back to 19,500, and if you have the S&P bouncing back toward 5,600, sure, the Russell's going to 2,400. There's going to be an advance. This thing is going higher. I'm not short the Russell. In fact, I continue to think that the Russell again will outperform the Nasdaq. And on that relative trade, I think that this chart will continue to actually go higher. I'm not disputing this. What I don't think, though, is that you're going to have a 20% correction in the Nasdaq and the Russell's going to be up. No, the Russell will probably be up, maybe down 5%, where the Nasdaq is down 20%. Yeah. Right?
I don't disagree. But for one last thing, I just to say about the Russell, and I think what's happening right now is that we're increasingly pricing in a chance of a soft landing. And I think that the reason that they all of a sudden are rushing into small caps is because they're increasing their probability that we're going to achieve that soft landing. What they were worried about previously was the Fed wasn't going to cut in time. And so what they were doing was they were owning large cap at the expense of the small caps, because they expected the Fed to, continue to pressure that trade. And in a high rate environment, that's what you wanted to own. You wanted to own the big cap, mega caps that can actually earn money in that environment. Now, all of a sudden, they're saying there's a decent chance that we're going to get the fabled soft landing, and that's why they're rushing into the small caps. So, Patrick, to your point, I think that if we get a situation where it increasingly becomes obvious that we're not going to get the soft landing and we're actually going to get a recession, then I think that they both get hammered.
I want to move on here, Kev, and I just want to talk about some of the actual Mag 7s, and let's talk about the two that had its earnings. And you could see Google disappointed on the downside. Again, the earnings itself weren't bad, but it comes down to the fact that in a lot of these fundamental analysts are looking for where that CapEx cycle turn is. And, when they're reading between the lines, they don't like what they're seeing clearly. And it started a sell cycle. And at this stage, this is the first time since the start of the year that Google's been trading below its 50-day moving average. And we've seen market corrections persist below here. It'll be really interesting to see whether this turns. The other thing was interesting about Tesla was it obviously had that epic short squeeze. But this disappoint has it at a pretty interesting moment. It's come down to its 50-day moving average, which is roughly about a 50% retracement of that rip higher. It's still at this stage, technically, it could find supports here, and it may potentially reverse. This is actually a critical line in the sand around this 210, 215 area, where we're going to find out whether Tesla breaks down or not and begins a new downtrend. The other interesting one that was the breakdown in Visa. And Visa has been one of these kind of financials services companies that peaked out in March. It was really interesting, but the stock has simply not participated. Many financial stocks, obviously it's not a direct financial, but many of the financial stocks have kept ripping higher in this last cycle. And Visa persistently struggled throughout the second quarter of the year. And now is clearly deteriorating. It's a very toppy formation right up here, and with this breakdown really opens the window for much deeper corrective patterns here. So it's interesting, but the earnings starting to disappoint, which has turned the market, and that's why next week is going to be so critical.
All right. What else you got for us?
So let's quickly, the dollar's in a muddle. I'm not going to comment too much on the broader dollar. It's much more about that US dollar yen. And you must have a wonderful smile on that. Show that smile, Kev, of how your long yen trade's been working. It was quite the reversal. And a definitive move. Now, when this broke down over here, we had targets with members around this 150 to 152 area. So I think at the short-term selling is going to just pause here. But I don't think that necessarily means it's going to be a reversal of the dollar trend, though. We could see a bounce here that could see this thing, retrace a little bit. But I still think this has been a meaningful trend shift. Do you think that this is now going to stick? Is there a reason you believe that?
You know me, I'm like a huge yen bull, and so I've been wrong. But I just want to do a little shout out to our friend, the Yen Whisperer, because I was early, which is the same as being wrong. And yes, I stuck through it, even though I got endless needling from Patrick in terms of sticking with my losing position. But the Yen Whisperer came on, and I did tell everyone on the show that he was talking about being long the yen, and he was absolutely correct. And I actually have to check in with him. Yen Whisperer, if you're listening, I'd love to get an update in terms of what you're thinking here. But I'm in it for the long haul, Patrick. I think this thing's headed a lot higher in terms of yen, lower in terms of that rate that you're seeing. And 152 was a nice obvious spot for it to pause. Everyone saw that. We obviously ticked there. And now I think it's a question of us just grinding much lower.
All right. Well,
everyone asked me for one last thing, Patrick. Everyone asked me for my target. And I'm like, I don't have a target. Eventually people are going to all be long and telling me why yen has to go to par, or to 100. And when everyone's telling me that it's got to go there and that they're all long out the hoop and, everyone's for sure convinced that it's headed there, then maybe that's when I'll think about going the other way. But right now I can tell you that this is just the start. And I suspect that the unwind of this trade is going to be huge. And we really even haven't had any real policy change yet in terms of the Bank of Japan. And although I don't think that's going to be what drives it, I do think that when that'll be exacerbate the move and it'll make them all the larger.
There you go. So I want to I reversed the chart, and this is the yen US dollar. And so what I think could easily happen during this period is I could go back, retest, create like an inverted head and shoulders pattern, cup and handle. There could be other stuff. But at this stage, this is a meaningful enough reversal where odds are that the low is in on the yen and the high on the US dollar yen is in. Obviously, there could be retesting of zones, but I think that level now is starting to establish itself as a key turn point. So you stuck it through, Kev. Congrats, buddy.
You know what? You never ever congratulate a trader with this trade on still on.
Okay,
So
sorry.
when this goes against
No.
me,
It's only
everyone's
you
gonna
could only be
no,
concerned.
no.
You should only be
Honestly,
concerned if
like
I join the trade. If I
no.
turn around,
Congratulations are just as bad. You know, I had something in Morris Sachs. I sent him something, and I didn't realize he's in the trade. And I said something positive, and he's like, "Great, now I'm gonna have to sell it." And I'm like, "Oh God, he understands." Morris gets it. You never congratulate anyone. And in fact,
I'm just yeah. But I've been shitting on you for months. I just needed to kind of.
No, I get it. I understand. You needed to eat some crow, but the reality is that next time I'd rather you just keep telling me I'm an idiot because I like that better.
Okay.
And just so you want to know, there was someone on my desk that congratulated me on Thursday, and it was at 152 yen, and it's been going straight against me since then. So you know who you are, and I blame you for this.
All right. Let's talk gold. And gold had that breakout to an all-time new high, looked like it was ready to go. It was interesting because it wasn't being confirmed by any of the other precious metals, including silver. But now it seems like it's giving it all back. Now, Kev, I am a gold bull.
Yeah, you are.
And I want it to go higher. But what did that just do up along those highs?
Oh, you're right. Yeah.
Did that prairie dog?
But you know what? You're using the future, and the future is not right because you have to use the actual. Yeah, let's see the spot if it did a true prairie dog. It is a noble animal, and you have to respect the chart formation. It's it's even a bigger prairie dog there.
Yeah.
Oh man. Yeah.
It's now. Listen, as far as I'm concerned, it's not a confirmed prairie dog if it doesn't break the neckline. Like, I mean, if it turns around and rallies higher, then there's no issue. But if this thing turns around and breaks down here, then it's no good. It's like
I would call that a prairie dog because to me, I don't think you need the bottom for it to blow out on the bottom.
The one thing to me, if it stays above its 50-day moving average and this manages to get back above 2,400 with some momentum, I'll still give the bulls the benefit of the doubt. It's not enough that it just popped and dropped like that. It's about whether the bulls defend pullbacks, and I think that's going to play an important part here. I wanted to touch on oil.
One second. I just want everyone to know I am not saying that I am a gold bear because of prairie dog. I'm just saying that the actual chart formation is just for a play down to the bottom end of that range, and that's it. Yeah. And to me, that's a legitimate prairie dog move, and I would be a buyer down there as well.
All right. Listen, did oil reverse, or is this a buy and dip in your mind?
I don't know. People seem to be very emotional about oil. Don't you find? Like there's a lot.
I actually find it's funny you say that because everyone in my circle, no one's interested.
I hang out with Paulo too much, and he's like talks about it all the time. And our buddy Paulo Macro, and there seems to be a lot of like chat about it. And to me, I'm like, it's going sideways. Like let's go pull out and like let's see a bigger a chart for a longer time. Like it's not really gone anywhere. Like where were we?
It's been dead.
So like in 2023 we were $75, and now in 2024 we're $75. It's like a whole lot of nothing to me. So I don't know. I just feel like there's continued chop is all I'm
on the very short term. I'm viewing this area as a fib retracement buy zone, and I'm seeing whether it holds. Now it's a very short-term call to see whether or not this becomes a turn point. If this thing starts blowing 76, 75, I'm stopping myself out. It's not like this is a very, very tight stop on this thing, but I'm dabbling here just to see if we get a reaction. So let's see what happens there. Kev, I want to move on and talk about copper because what a drop this has been.
Yeah, it's the metal with the PhD, right?
Absolutely. And look at the recession that's coming here, buddy. No, but no, it's interesting. The one thing that I want to
before you say it, what's interesting is the fact that 3 months ago the global economy was on fire and there was no recession on the horizon, and that today everything's coming to a screeching halt.
But let me ask you. I mean, I've got a speculation. You tell me whether or not you agree with the speculation or not. So everybody was talking about the AI boom, and one of the second derivatives of that was the fact that there was going to be all this energy consumed, and so you had to invest into uranium because people are going to be building nuclear plants to power all these AI data centers, and that copper was going to be needed for all the wiring and everything. And I think that do you think that all of this was a part of that bigger bubble?
No. I think that it might have contributed a little bit, but let's face it, the AI bubble has come off, a week ago, 2 weeks ago? Copper topped out in end of May, right? Like,
yeah, but the real breakdown's only been in the last week or two, right?
Yeah, but we definitely topped. It was 512. It's 412 now.
Yeah,
like we're $1 lower, and like the reality was it topped, 2 months ago. I think it was, listen, when it was happening, it was once again a series of rolling mini bubbles. This is what happens time and time again, and it's just a question of how far they go. People grab hold of a theme. We had Jeff Curry talking about this, the trade of his lifetime. Pierre Andurand talked about how he didn't want to own oil anymore, and he was just going to own copper. And at that point, everyone, yes, you're right. Part of the narrative was that we were going to get this, dramatic usage increase in copper because of it, but it had more to do with just the hype. And I think this is just a cycle that we're seeing time and time again, Patrick, that we get these kind of overdone stuff. And now, like, if anything, it feels to me like people are way too bearish on copper. Like, we've gone from copper's going to the moon, it's going to $7 to now it's like it's never going up again. And it just shows you how manic this market is. And all I can say is the more convinced that FinTwit and talking heads and TV are of a trade, the more you should be skeptical of it.
Yeah, I'm at some point copper is going to be a great buy, but when you have a Eiffel Tower formation, it usually needs to find a base, and so the idea that it even temporarily dips below $4 and then spends a month or two down there is within the technical framework. At some point, the way I'd put it, we're definitely much closer to a good buying opportunity than we were to top. I don't think I would agree with that. It's not like it's going to go down a lot, but I think this is like you being in the yen 3 months ago, where it's basically, it's cheap and it's going to work. But I think that you're just early.
Listen, I'm in no rush to buy copper. Like, I agree with you. It's falling. What's it going to do? Go back to that 50-day there? Like, you're going to get 20 cents. You're going to get a 20 cent, like,
I think we could see this in copper for the next couple months.
And it's going to be like oil. It's going to just, frustrate everyone.
It's going to frustrate everyone, and then it's going to be an epic buy. So we'll have to see.
There you go.
What I want to talk about is uranium. Now, the U308 contract's down to $82. Uranium's been weak, but this Sprott Physical Closed-End Fund continues to sell at a greater than 10% discount. It's being hammered by selling. And it really kind of just shows that this market continues to take a lot of pressure. The story just lost all its momentum, and now people are just tired of holding it and are just unwinding their overweight positions in it. I still am quite bullish uranium in the bigger picture, but boy, is this just relentless selling.
I don't think you touch it until it goes to a 20% discount. I think the discount will be a record wide, and at that point, it'll show the true kind of sentiment that it's washed out, and I think that's where you buy it.
Yeah.
And I've been saying that for a while, that there's no rush on this thing. It's going to a bigger discount.
Well, the uranium stocks themselves have finally started correcting too.
Yeah, that's true. You're right. All right, here we go. Now he's going to talk bonds because they're actually up a little bit. So, oh God, he's going to be unbearable.
Listen, all I'm saying at this stage of the cycle, this is a good. I believe bonds will behave as a hedge during a period where the market is pulling back, and do you
think that they'll behave as good a hedge as they have in the past?
No.
Okay, good.
No, because I don't think there's going to be a bull market in bonds. I just think there's going to be a safe haven. You're going to pick up a yield. They're going and in a period where things are softening, yields are not going to be pressured higher at this stage of the cycle, I do still see your secular story. Like in 2026, could we have inflation surge again in a big way and bonds have their face ripped off? Absolutely. I just think that at this moment, at where we are in the cycle, that this is a place to hide. Now, I think that you can own this tactically at this moment, and I think a lot of these 10-year and 30 years will. Obviously, the 2 years a better safe haven on the short term.
Right. So, like in the past, when you couldn't use leverage in an easy way, I would agree with you that was what people would go do. But like with the advent of TUA, like Harley's
TUA.
product and stuff like that, I think that you're gonna. There's places to hide, and you can actually. We talk about the yield curve and it seems so sophisticated and most people can't play the yield curve, but you can play the yield curve because you can go and buy TUA instead of buying TLT. And that's in essence a yield curve bet. And I think that's what a lot of people are missing is that when you're choosing TUA over TLT or whatever, IEF, whichever one you want to pick, you are making a yield curve bet. And I continue to believe that we are going to steepen. We're going to go to record wides. Everyone's going to be surprised at how wide we go.
Yeah.
Anyways,
listen.
You like them both. You just like anything.
No. Look, I just think right now, that you don't want to have too much equity on your books, and you can either hold cash. Or you can sprinkle some into bonds as a safe haven. All right, let's move on. I want to talk about this Nikkei because what a pop and drop! What a pop and drop!
I haven't actually looked at the chart lately. It's one of my charts I try to just not look at. Okay, Patrick, tell me where we buy this again. Yeah, I did. It's a prairie dog. Although it's not a true prairie dog because unfortunately
it didn't have multiple highs.
Yeah, you need like gold was actually a better prairie dog.
But it was a fake out to a new high, right?
That's
like
correct.
It spent 3 days above there and then just got its.
Okay, so where do I buy this again, Patrick? Because I'm only going to add to this.
Are you tactical buy as in a swing trade, or are you talking bigger picture?
No, I'm just talking about where do I add again?
Well, listen, I think that this is now on a 10-day basis so oversold that it's going to react back to 40,000. So there's a tactical short-term trade to fade this selling. But it's very if the whole I think at this stage, because of the currency reversal and other factors like this, I think that this will start to correlate more with the other global developed markets. I can see a scenario that if we see the U.S. and the Euro stock both selling, that the yen will find it very difficult to buck that trend and will succumb to that pressure. I think that you have to play it as a developed market and that they're all going to correlate.
Whoa. What are you saying there? You're saying that the yen is going to...
Not the yen, the Nikkei, sorry.
Oh, I'm sorry. Okay, you're confusing me. Because actually, I realized part of the thing is that I own this in yen. So although I'm down in terms of my actual Nikkei holdings, I'm up on terms of the currency.
Yeah.
Right? So it's probably not as bad as it looks in terms of...
Yeah. I mean, this has been 11% off its high.
Yeah. And so the yen hasn't gone up 11%, but...
Yeah.
So tell me where do I buy it next, Patrick? Like when I want to add to this, not on a tactical swing trade. I'm talking about like
it's too early. There's some new sell cycle, and you have to see where it goes. Like that's like asking a month or two ago where to buy the copper. Like to me, this was a clear reversal of trend. And I think that this is going to be in some sort of a multi-month correction. That will be a buying opportunity. But the question, I would leave it alone for now. In terms of adding, I wouldn't add. I'd leave it alone for a month. You can ask me again in September, October. We'll see where the chart's kind of settling in.
The other thing I want
to, what I want to touch on here is this Euro stock, and this has been an incredibly heavy chart, and very toppy, and rolling over, making lower lows. I think you can be even more bearish the Euro stock than the only thing that I want to be short the Euro stock even more than I want to be the S&P, but then I look at the Mag 7s and how much room they have to go. But I still think this is a chart that's going lower.
Yeah, listen, it's under the 50-day. It looks like it's hitting new lows. It looks heavy. It looks like it hasn't even had its real whoosh yet to the downside.
Yeah, no, I think that we could see 4,500 on the downside on this one as we go. All right, Kev, that's what I got, buddy. You know what? Actually, no, it isn't. I want to talk about healthcare.
Yeah.
No. But listen, the healthcare index itself has been ripping, but a lot of really interesting charts in the pharma space, like Johnson & Johnson beat on its earnings, is ripping higher after it being in a multi-year downtrend. You then take Pfizer, which has been in an awful bear market, putting in its little cup and handle formation and starting to turn up. Bristol Myers this morning beat on its earnings after being in a 2-year bear market and been declining. These big pharmas that have been the dogs have suddenly come to life. And it's really interesting. I think that this is actually a place where there will be new money flow. And in that sector rotation, I think these kind of big pharmas that are been beaten down, are going to continue to actually work here. I think that this is a place to go.
I agree, Patrick. And one of the smartest money managers that I talked to, he runs a hedge fund, multi-billion-dollar hedge fund. We were talking about the breakdown in the Mag 7, and he said, those Mag 7s are really big stocks, and there's a lot of market cap there. And yes, to some extent, people will chase the smalls. But if you really want to buy something that's down and out, that people are underweight, it's healthcare. And that's what you're, that's where the money can go and can be put to work in enough size that it's actually going to attract the Mag 7 money. And like, you just pull up XBI. Did you go through that chart?
No, but I was going to just show Amgen, which has been doing so well, and that's in the biotech. Now see, this is where, okay, you like your little XBI, right? Yeah. And the XBI certainly has been working higher, looks good. But my argument when you gave me the XBI argument was that I thought the big cap version of the IBB was going to outperform,
and it has. You're absolutely right. You're absolutely right.
But both have been winners. I just thought that,
and I'm not going to deny that. I'm just saying the XBI chart looks like, I joked and I wrote it in my chat that it's like when a 13-year-old sees his first Trans Am. That's how sexy the chart looks. Like, it's just awesome.
Well, there you go. All right, Kev, that's all I got, buddy.
That's it for us all, right? Let me just pull up this thing here. All right. Thanks for tuning in. We appreciate you spending some time with us. Patrick, where can they find more about you and your wonderful firm?
Now, you can find me at bigpicturetrade.com or follow me on Twitter at Patrick Ceresna. And Kev, where can they follow you, buddy?
They can go to themacrotourist.com and listen, bear market, bull market. We're just happy to spend some time together on this crazy ride. Now stick around for the after show.
All right, Danny, join us.
There he is.
Hey. All right, Danny. You know what? He's starting to join me on these beers.
He needed a lot of encouragement for that.
Do you want to go first, Danny? Give it a rating.
I quite liked it, actually. I would give that a good 6.5.
Oh, he's a tough.
That's a good rating for you?
Yeah.
I don't know. You keep telling me to go lower. So.
Actually, I like this beer. I
think it's okay.
Yeah. I'm going to give it a 7.8. It's I would totally buy this beer again. This is a good drinking beer.
Yeah,
nice.
But it says it's low alcohol, but this one is 4.5%. So I don't know what they were talking about there. It's not low alcohol. You see that?
That's pretty. Yeah. Well, I guess if it's 5% or 6% is a standard, then it's certainly not low alcohol for American light beer. But it's 4.5%. It's a light drinking beer for sure.
What was your rating, Patrick? I missed it.
7.8.
7.8. That's nice.
Yeah. So Kev, I'm coming back to Toronto, buddy.
Yes, it's going to be fun. I'm looking forward to it.
Finally coming back to the motherland.
The motherland. Did you see that Twitter thing where there was it says up here in Canada we water our moose? And there's some lady that this moose had gone on her front lawn because it was so hot, and she was just hosing him down. Like a big bull moose. It was awesome. It was like this huge bull moose. I was thinking about you. I was there. Patrick would be oh, there's dinner. Let me go get the rifle. What a cute animal. Boom. Patrick, I know you don't listen to the interviews ever, but just so you know, I'm introducing a new question. And the new question is, you got to share either a book, band, or a broadcast, which can be like a TV, movie, or podcast that you recently discovered.
I got nothing.
I know. So I thought about that, and I was like, okay, Patrick's going to be useless at this. But luckily, I got Daniel. So while, Daniel, I'm going to put you on the spot. But in the meantime, I'm going to tell you about something that I have recently stumbled across. Actually, my wife told me about it. And when she told me about it, I was like, that doesn't sound that good. Like, that doesn't sound like I'm something I want to like. And it's called Dead Eyes. And it's a podcast of a guy that as an actor, he had applied to, or he'd actually more than applied. He had won the role of on Band of Brothers for a small bit part. But then Tom Hanks came to direct that one. And he basically got fired because of his quote unquote dead eyes. And it's literally, I know it sounds stupid. Like, it's like, seriously, the guy made a podcast about this, but he's a comedian. It's funny. He gets all these people that are like, it's a lot of inside baseball about the movie business, acting business. It's, like John Hamm's on it. One of the Saturday Night Live guys is friends with him. And they just talk about like how it works and a little bit of insight into his dead eyes. And it is just hilarious. And I'm telling you, it sounds stupid. It sounds ridiculous. And if you're all interested, go listen to it. It's an absolute fantastic podcast.
Sounds good.
Daniel, do you have anything? What are you listening to new that's book, band, or broadcast?
If it's podcast, I actually really like, there's a TV show called It's Always Sunny in Philadelphia, which is
yes, yep.
So I listen to their It's Always Sunny podcast. I think it's
really?
So yeah, I love
podcast.
They do, yeah. So
like
many
good. Like the actors?
Mm-hmm. All the actors together, and they basically just talk about different parts of the show or how they did this or the inspiration for this. And it's just hilarious because they play.
Oh, I did not know that. Do you know what I stumbled upon? I was looking for something to watch, and I watched the Wrexham thing with the soccer or football, as you guys call it, in terms of Ryan Reynolds and then the guy from Always Sunny. Which guy is it? John. It's a mix. He's a mix something.
It's Dennis. It's It's the one that plays Mac. He plays Mac. Yeah.
Well, anyways, they bought a football team together, and it's like, I would say it's more about the football and about the actual town and about the players than it is about those two Hollywood stars. And it's been fantastic. I've really enjoyed it. Like, it's awesome. Have you had a chance to watch it?
I haven't yet, no, but I know Wrexham.
Yeah, and I guess that at one point they were a good team.
Yeah, I think so.
At one point. Well, yeah, you're too young for that.
Yeah.
Patrick, you know what I did? Like, I had no idea about their whole system about how if you don't make, like, they send down the two worst teams, and then teams can move up. Do you understand how football works? No, we got to do this in the NHL.
They do that in rugby too, right? Like
I don't know, but we got to do this in the NHL.
Like, basically, the shit teams get sent down, and the best teams work their way back into the league. Like,
we need to do this. We need to do it so, like, you're a shit team in the NHL. You got to go play in the AHL. Yeah, would it be hilarious? Like, I think it would be awesome.
But the problem is the AHL is all the farm teams on.
I get it, so but it still would be funny. Like, it
would be awesome. They should drop the NHL down to 20 teams, and there's 10 teams.
Well, you and I are like, we're Canadian. There should be 6. For those who don't know, that the NHL was originally the original 6, and those were the important teams. So let's see, Patrick, can you name the 6 teams?
Yeah, was it Detroit, New York, Boston, Montreal, Toronto, and oh my God, fuck, who's the fifth?
Did you say Boston?
I did. Chicago.
Oh, there you go. You go Chicago. Okay. Those were the original 6. And they, by the way, they have all 6 of them have the best jerseys.
No, in Detroit.
Yeah, you named that. You started with Detroit.
No, did I? Okay, yeah.
Yeah, you got them. But they had the best jerseys. Anyways, so Patrick, you think could give us one? No, a book broadcast?
Absolutely not.
Okay, I like it. I like the honesty. All right. Thanks for tuning in, everyone. We'll see you next week.
Cheers, guys.
2 weeks. Bye-bye.